What are the first two key principles of tax planning? And how can you take advantage of them and even use the same strategies that the hyper wealthy use to keep your taxes down? We'll talk about that today. Hey guys, my name is Jeff Cottle. I'm one of the senior attorneys at Anderson Business Advisors. And today I'm excited to talk with you about tax planning. They will peel back the curtain a little bit so that you can start to think like a tax planner and start to leverage some of these strategies that we'll talk about, many of them the same ones that the hyper wealthy use in your day-to-day investing, so that you can keep more of your hard-earned income and reinvest it and deploy it in the way that you see fit. So what we'll do then is we will first talk about, well, the first basic principle of tax planning, and that is that you actually need a tax plan. We cannot be engaging in tax strategies haphazardly or half-heartedly, or in tax preparing rather than planning. It may sound a little reductive, but I'll explain why this is so important in just a moment. And then the second key principle is that there are actually two tax codes in the United States. The first is the one that we like, the business tax code. Literally just gets more advantages than does the second one, which is the personal tax code, one that we want to avoid at least as much as we can. And then after that, we'll touch on some of these more advanced strategies and how you can leverage them in your investing the same way that the hyper wealthy do. Let's jump right in. So the first principle of tax planning is that you actually need a tax plan. This may seem a little obvious, and it's also true though, that we have work with so many thousands of clients who engage in tax strategies on their own, or who are working with tax preparers that just don't see the whole picture. They engage in strategies haphazardly or half-heartedly, and in ways that in many instances either do not save them taxes or may not qualify them, or may not be following all of the regulations, or even worse, are engaging in these strategies in ways that cause them to actually have more taxes. I see it happen all the time. What we really need is to have a holistic plan. Tax preparing is not sufficient. Filling out forms before the IRS and having a tax preparer do that in and of itself is a good thing. We all need tax preparers. And it's also true that what we really need in order to save on taxes is somebody who will sit down with you and go over your assets, your income, your liabilities, your expenses, and your goals for the future as a whole, and put together a plan for you based on that. Let me illustrate, though, how important this is. I was talking with one of our head tax strategists here at Anderson Business Advisors one day. This was a couple months ago. And he says to me, Jeff, you're not going to believe this, except you really are, but I just saved a client more than $300,000 in taxes after one phone call. And I said, really? And he said, yes. And he and I sat down and crunched the numbers. It was not an exaggeration. I don't want to get too far into the weeds, but I'll give you the basic rundown. The savings were based on the way that this client was leveraging their S corporation and the ratio of salary versus distributions. Just one simple adjustment there as a part of a tax plan saved that client more than $300,000 in taxes. This client was elated, but also really frustrated. Why would he be frustrated if we saved him so much in taxes? Well, the answer is because he was working with a CPA before coming to us. He was working with somebody who should have known this. Here's the key, though. That CPA did know this. Our client then went and talked with his former CPA and asked him and said, hey, how come you never talked with me about this strategy? How come we never used this? The CPA said to him, well, you never asked. This is why it's so important to have a plan and to work with a tax planner, is because with that plan in place, we not only lower taxes, but we help you achieve your broader goals as well. So that's the first principle. It's how vital tax planning is, and having a plan that encapsulates and encompasses all of your investments. The second thing then is that we need to make sure we take advantage of the IRS code the way that it is. And specifically in this case, we're talking about the two different codes, the personal one, where we're just taxed more, and the business one, where we get more savings. You see, what happens is individuals like me and you, when we are taxed like this. We earn money, we are taxed, and then we spend it afterwards on whatever it is that we want or need with that income. Businesses are different, though. Businesses earn money, they get to spend it on their expenses, and then they are taxed on whatever is left over. This is key to the rest of tax planning. It's actually really funny. I saw a meme going around online once that had somebody saying, "You can't pay taxes if you don't have income." And while it was meant to be a joke, whoever made that, they don't really realize how vital that is to actually saving on taxes. Is if we leverage that business tax code and we rack up business expenses, we just literally have less income to be taxed on. I've done it with so many of my clients where we start a personal business on the side, whether that's in real estate investing or another small business of some sort. Frequently, it is real estate investing, but not always, where they can then funnel a lot of their income. And in fact, this business may lose money in the first few years. And that's fine, though, because when it loses money, the income goes down, and the total income for this client also goes down. What happens? Less in taxes because less income. And this is how the hyper wealthy do it, is that they move as much money as they can over to that business side where they earn money, they spend it on expenses, and then they're taxed on whatever is left over. And this is why real estate investing is so popular among the hyper wealthy, is because real estate is a great asset that grows in value, and that can be a wonderful investment over time. And it's also true that it's really easy to get money that you have in real estate into that business tax code, so that then you can use these real estate expenses to save on taxes. Lastly, though, it's also true that real estate is not the only way. Our traders, our investors in the stock market can also do this same thing. Working with us here at Anderson Business Advisors, I've set up for many a client a business entity, usually a corporation, for my traders so they can send some, not all, but some of their trading income over to that corporation where they can engage in the more advanced tax planning strategies. Why? Because that corporation falls under that same tax code of earn money, spend it, and then be taxed on what is left over. So if you've heard of, for real estate, cost segregation studies and depreciation, that's where all of this comes in. Or if you've heard of some other strategies that small business owners use, like 280A or the home office reimbursement, or other expenses like internet, cell phone, travel expenses, even medical expenses can be tax deductible that lower your income. We can do all of that using a corporation. Why? Again, because that corporation falls under earn money, spend it, and then be taxed on whatever is left over. So those, again, are the first two key principles of tax planning. And that's how we open the door, is leveraging those. We open the door to our more advanced tax strategies by understanding them and how to deploy them, not just for the hyper wealthy, but for you in your investing as well. And guys, if you really like this video, hit that like button. And also, if you're interested in learning more about how a proper tax plan can save you thousands, tens of thousands of dollars in taxes, click the link below to get a free strategy session with myself or one of our other expert strategists and attorneys. Thank you and take care.